Investing is the most important thing you can do to reliably build wealth during your life. The problem is, you inevitably suck at it.
You hate Wall Street, but maybe it's time to quit.
I love my job.
You hate your job.
I love my job.
You're miserable.
I love my job. I love my job, honey.
The S&P 500 has a historical average return of 10.4% over the past 100 years, even when including all of the major stock market downturns during that time. $10,000 invested in 1972 would be worth $1.7 million today. But look around, and you will be hard-pressed to find anybody that has made themselves wealthy exclusively through diligent investing practices. Research done by Dalbar Inc., an investment research firm, found that the average equity fund investor only made an average annualized return of 4.25% over the past 20 years. To understand how big of a difference this truly is, the same investor getting those returns would only turn their initial $10,000 investment into $83,000 today over the same 50-year period. People are terrible at investing. You are terrible at investing. And even finance industry professionals are by and large terrible at investing. The only real solution is to stop trying.
I need the money.
So it's time to learn how money works to find out why you are a terrible investor who is almost guaranteed to get returns below the simple market average. This week's video was sponsored by Brilliant. Learning new ideas can be tricky, and while lectures and books are great resources, there really is no better alternative for being able to try new things for yourself in an immersive way. Brilliant makes this possible with their wide range of hand-on interactive courses in math, science, and computer science. I have personally found artificial intelligence and machine learning to be very fascinating. The problem is I don't have the technical knowledge or the know-how to get into the fine details of either of these fields. One of the hardest things to do in business is to keep up with industry trends, and being able to speak intelligently to them is important to keep up, which is why I was so keen on understanding this space. Fortunately, I took Brilliant's practical lesson on neural networks and quickly formed a deep understanding of how these amazing systems work. To get started for free, visit brilliant.org/howmoneyworks or click the link in the description, and the first 200 of you will get 20% off Brilliant's annual premium subscription. Investing is a hyper-logical procedure where the end goal is to turn your initial supply of money into as much money as possible. The trick to doing this is very simple. If you put that money into ventures that become worth a lot of money, produce a lot of income, or preferably both, you will be investing well. Most investments don't generate returns in a totally predictable way. Shares in a company, for example, will have some years that see the company pay out big dividends to investors, and other years the company might pay out nothing. Similarly, there will be some years where the shares in the company are trading at all-time highs, and there will be other times when they are trading down by 50%. This is simply what investors call risk, which I am sure I probably don't really need to explain to any of you, because you all know what risk is, right? Well, you might know what it is, but I guarantee that you are terrible at dealing with it.
F you, Sam. Will you give me a fucking break here?
Our monkey brains have evolved over millions of years to avoid risk, even if it means foregoing a reward. Securing yourself a tasty snack was not worth being eaten by a lion, which meant that only the more cowardly monkey survived. The problem is that you need almost the opposite mentality to be a good investor, but let's see how you do. Assume there are 3 investors: Mr. Lucky, Mr. Unfortunate, and Mr. Consistent. Each of these men are going to put $1,000 a year into their stock portfolios, but they are going to do it in slightly different ways. Mr. Lucky lives up to his name, and he invests his $1,000 at the absolute bottom of the market every year, which means for the remaining days in that year, his investment is only going to go up. Mr. Unfortunate does the exact opposite. He also tries to time the market, but screws it up royally. He invests at the very top of the market every single year. This means that the remaining days in the year, his investment can only go down. Mr. Consistent doesn't bother with any of that. He just takes his $1,000 and puts it into the market on the first trading day of the year and then forgets about the market for the next 12 months. None of these investors sell any of their shares, and they reinvest their dividends straight away back into their portfolios. Now, who do you think would have the biggest portfolio after 30 years of investing?
Who the f knows, right?
Lock in your answers now. I'll give you a hint. It's obviously not Mr. Unlucky, although he probably doesn't do as bad as you might expect. Even with his terrible year-on-year luck, he still comes out well ahead after 3 decades, earning an annualized 8.7% ROI, which meant that his $30,000 total investment would be worth $137,725. The reasonable choice would be Mr. Lucky. After all, he picked the best day to invest every single year. He did earn impressive returns of 9.6%, which means his portfolio is now worth $165,552, or almost $30,000 more than Mr. Unfortunate. Particularly impressive when you remember he only used $30,000 of his own money to grow this portfolio. But what about Mr. Consistent? Well, he may not have had the market timing skill of Mr. Lucky, but he had something else on his side: time in the market. You see, while Mr. Lucky was waiting around for the very best day to deploy his capital, he was missing out on dividends that could have boosted his total returns. By investing money as soon as he could, Mr. Consistent ensured that he got every dividend possible, which more than made up for the total down days he would have to ride out. Mr. Consistent made annualized returns of 10.2%, giving him a portfolio value of $187,580 after 30 years. This thought experiment was first presented by Peter Lynch, one of the greatest investors of all time, and he used it to demonstrate that time in the market beats timing in the market if you are an absolute genius that can pick the bottom of the market perfectly.
Dangerous when they invest. This word, play the market. That's a dangerous term.
In the age of cryptocurrencies and hype stocks, we have normalized vertical price charts as something you should expect if you are a good investor. Sorry to ruin the fun, but good investments shouldn't moon overnight. And extreme price volatility is really only the sign of a very unhealthy investment. If it can go vertically in the direction you want, it can also go vertically in the direction you don't want. Established companies with not much room to grow are also great investments, even though their stock price might trade flat over the long term. If a company has grown as much as it can, returning money to shareholders is a much better decision than looking for new ways to spend that money on growth that isn't needed or isn't possible. Over 40% of the growth from the broad US stock market in the past 100 years has come from dividends. All of this demonstrates that just getting into the market, even if it's at the worst possible time, isn't going to be that bad in the long run if you hold on to your investments. I should mention that Peter Lynch probably cherry-picked the years that he ran this experiment to give himself the outcome that proved his point, and that follow-up studies have shown the more logical result of Mr. Lucky coming out slightly ahead, but that's not really the point anyway. The big deal here is that long-term, these investors all did roughly as well as each other regardless of short-term gains or losses. Humans are inherently oversensitive to short-term risks, but undersensitive to long-term risks. It's why we smoke and eat sugary food that we know is going to eventually kill us, but still get scared at flying in a plane that is probably perfectly safe.
Nervous?
Yes.
Monkey brain is programmed to keep you alive day by day. Monkey brain don't work very well conceptualizing risks over decades. The biggest long-term risk you have while investing is missing out on long-term gains, and a surefire way to avoid that risk is to invest as early and consistently as you can. But the risk of seeing red numbers on our brokerage account keeps you from doing it. Our monkey brains also sabotage our portfolios by encouraging us to participate in herd mentality. In the wild, there is safety in numbers. If your monkey buddies find a new territory full of food, you would be best off following them. If nothing else, the lion might eat one of your buddies instead of you. We can see a similar herd mentality all of the time in investment markets. My good friend Patrick Boyle recently released a video on Cathie Wood's ARK Invest where he demonstrates the core problem with the returns she generated for her investors. ARK's innovation fund is now doing roughly as well as the broad market, which by itself is perfectly acceptable. The problem is that in 2021, her fund was up 150% and making headlines throughout the investment world. If you were an investor in Cathie from day one, you would be doing okay for yourself right now. But most people didn't invest with her on day one. Most people started investing in her when she was making headlines about triple-digit returns. There were a number of market forces that pushed the value of this index back down, all of which Patrick explores perfectly in his video. But all that is important for now is that even though the index was still up by a respectable margin, most of Cathie's investors had suffered devastating losses.
Right now, it is ugly times ugly. And that's when the ugly get going.
I shouldn't pick on Cathie exclusively. The same kind of net loser effect is going on in lots of markets right now. If you bought Bitcoin when it was worth less than $1, you are still doing extremely well for yourself. But most people bought Bitcoin when it was worth more than it is now. So even though the asset is up millions of percent since inception, most investors are still net losers. Our monkey brains want us to follow the herd. But in the investment world, that just translates to buying assets once hype has pushed their prices to all-time highs, or selling positions after everybody else has crashed the market. I get it. It's hard not to follow the herd when investing, because finance is a really complicated subject. Making decisions yourself is probably going to do more damage than simply sticking with the pack. There are not many people who have consistently outperformed the market over an extended period of time. Of those that have, a good amount just got really lucky. A lot were insider trading, and those that genuinely beat the market with their own skill were mostly certified geniuses that transformed the investment landscape. You are watching a video on the dynamics of human psychology and investing, so you are probably smarter than most, but you are not smarter than someone like Jim Simons and his team of PhD analysts. The good news is that you don't need to be. The secret to good investing was right there in the thumbnail. Stop trying. That doesn't mean stop investing, but it does mean stop trying so hard. You can fit everything you need to know about personal finance onto a post-it note. But that makes it hard to sell courses, investment products, self-help books, and NFT projects to people who think they can outsmart the market. A 2020 report found that 90% of actively managed funds failed to outperform the market over a 15-year period. So if the smartest investors with Ivy League degrees fail to do so, why do you think that buying a day trading course will help you? I'm sorry, you can't.
I cannot f***ing believe this shit.
Invest consistently, invest broadly, and invest for the long term, and you are going to do better than almost everybody else that spends their lives chasing the overhyped flavor of the month investment that promises its investors rich but only ends up putting them behind. Now, if you want to learn about a company that has quite literally mastered the long game, go and watch my video on Nintendo's incredibly weird 130-year history on my new channel, How History Works. Thanks again to Brilliant for making it possible for everybody to keep on learning how money works.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
What?